Welcome back. You're still tuned into Trading Hour. The market is inching even higher right now. So it's a 190-point gain that we have on the Nifty. We are at the day's high currently, but a little bit of underperformance is coming through from the bank. So do keep your eye out on that. Even that said, it is a gain of around 0.6%. So all in all, we do have a good looking screen. But let's talk about some key earnings which came through. Transport Corporation of India is in focus after reporting its second quarter earnings. We did see a steep fall in the seaways margin, which is weighed on the operational performance. We'll talk more about that as well as the outlook going forward. And for that, we have Vineet Agarwal, Managing Director of the company, joining us now. Vineet, good morning and thanks for joining us. This is Pavitra. I'll get to the individual segments in just a bit. But first, if you could sort of take us through the overall performance and really break it up into how much has come through on the volumes and on price hikes.
Hi, Pavitra. Always good to be here. This was our record quarter so far in terms of the revenue growth in total. And this is on the basis of the fact that there is a lot of pent-up demand that exists, and almost all our divisions did well, barring, of course, the seaways business, which has been going through the current fall in freight rates have impacted it a little bit. But more importantly, the division went through almost 3 of its ships went for dry docks over the quarter, and that led to less operational availability of the ships in this quarter, and hence it was lower margins. But overall, the business remains extremely robust. We are seeing huge demand coming in, for example, for the automotive sector. We saw the festival season again keep up the demand overall. So overall, it was a good quarter for us, barring a little bit of a blip on the seaways side.
Take that point, because if we just take a look at the other segments as well, freight has grown 14%. We've seen a 26% growth come by in the supply chain business as well. But Vineet, just a couple of questions with regards to your overall outlook. I mean, the first half you've done 21%. You had guided for around 15 to 20% in terms of revenue growth for this year. You expected margins to sustain. What is your outlook for the revenues for this year? And seaways, when do these dry dock ships come back to operations, and where do margins stabilize there?
Yeah, so essentially the 10 to 15% growth on the top line and the bottom line in terms of guidance stands, because Q3 and Q4 was quite robust for us last year. And I think some of that momentum from now will continue, but perhaps a little bit slowdown in the fourth quarter might be there. But barring that, 10-15% on the top line, bottom line is expected. On the seaways side, the ships are already there. They came in the first week of October. So the next 6 months, that is the Q3 and Q4, we will see full results from them. We have to note that the international freight market has come down quite a lot, about 30+%, and that has had some impact on the local market as well. We did some trips to overseas markets, and capitalize on that when the rates were high. But clearly, good times on those sectors do not last forever. So we have come to a normalized state of margins right now, and I think going forward, the overall 10 to 15% will stand.
So what is the normalized state of margins for the seaways business? I mean, we've seen it at 35% same time last year, which you said was obviously a blip. Now they've come down to 25%, but that's primarily on account of 3 of your ships not being in operations. Now those numbers are here. I mean, are we looking at 27, 28%, 30, 32%? What is a normalized level?
So the typical margin that business is at about 30-odd% EBITDA. And that's where it would possibly be. You're talking about EBIT margin, talking about EBITDA margins. So EBITDA for us would be about 35% odd. And we will come back to that in these 2 quarters.
All right, got that. So that is on the seaways business. Could you take us through how the festive season is looking for you? Because, the last time we spoke, you did say that festive season stocking has begun, but there was also some disruption that you were facing because of the auto sector. So can you tell us how things stand now?
Yes, the auto sector has come back with a bang. I think there is a lot of pent-up demand that is going through across the country, and we've acquired new contracts in both in the supply chain side of the business. And this is not just on the road side, but also on the rail logistics side. As you know, we also own 3 trains for AFTO, which is the automobile freight transport. And we are doing that quite robustly. We have yards that we've set up for automotive transportation. So what happens is that a bulk movement takes place by rail, which helps companies to save costs as well as helps them to reach their ESG goals. And then we do a distribution through a spoke method. So it's a hub and spoke method for auto distribution. And we are seeing a huge amount of traction here, not just four-wheeler, three-wheelers, but also two-wheelers to some extent has picked up, but tractors have picked up also to some extent.
Tractors have picked up. We've seen that in the commentary that have come in from M&M Escorts as well. And more importantly, the stock price of M&M also this year has rallied almost, what, 60, 62 odd % there. But the cold chain business, that was your, new baby, so to say, which you entered just about a year ago. How has that scaled up? What are the long-term plans for that business?
The business has grown by about, in the half yearly, I think about by 20% odd. And we are in line with our targets. We have acquired some more contracts for some QSR companies and also some retailers. We also do some work on the dark stores for some of the new startups, but their business model keeps changing. So that has an impact, and we don't have a predictable cycle sometimes with them. But it's very exciting right now with all the consumer trends that are changing. Visibility in terms of pharmaceuticals now moving a lot more towards cold chain or even specialty chemicals. So it's very exciting for the next few years for the cold chain business.
Now, and what rate is it expected to grow at?
We expect the business to grow at about roughly about 30% this year.
How much does it contribute right now?
I'm sorry?
How much does this contribute to your revenue right now?
It's very small right now. It's a very small business right now. I think last year we did about 60 crores. Okay. This year we should do about 80 to 90 crores.
Okay. Vineet, just one final question. What is the kind of Capex that you're looking at? Is there anything expected soon?
The Capex plan for the year is about 300 odd crores. However, with freight rates coming off, we were hoping that the ship rates will also come back faster. That has not happened. So we are struggling to acquire a new ship. Okay. We're hoping that Q4 we will be able to do so. Barring that, the Capex should be between around 150 crores.
All right, take that point. Wish you good luck, Vineet. You've done well in the past, but in the recent past, we've seen some weakness in the stock price. Let's see where that goes from here. 300 crore Capex if they buy a ship, 150 crores if they don't. The stock currently at the low point of trade, primarily on account of weakness in the margins, which the company believes that will normalize once things recover in the shipping business. 3 of their ships were in dry docks in the previous quarter. With that, we'll slip into a short break, come back, get you more on the markets as well as individual stocks.